Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. And today I'm joined again by Ben Plohl, buyer's agent, accountant and property strategist to unpack how investors are adapting in the post-budget environment. We explore why property investing isn't dead, but the old buy and hold and hope approach may need a rethink. Ben shares how investors are looking at cash flow, value add opportunities, dual OCs, unit blocks, and alternative strategies to make portfolios work under the new rules. We also discuss the long-term fundamentals supporting Australian property, where supply constraints are creating opportunities, and why the right asset selection matters more than ever. From established properties to the risks and opportunities around new builds, this episode is all about making smarter decisions in a changing investment landscape. Let's get into it. Ben Plohl, thanks for joining me back on Geared for Growth.
Hey, Mike, good to see you. Thanks for having me back.
It has been a little while since we've chatted to you, and of course, with your background, obviously you're an accounting, finance wizard and buyer's agent. I was keen to hear what the world is like post-budget. I think maybe some of our listeners are sick of every episode going like, what's it like now? But we do need to understand what the rules of the game are and how the battlefield is playing out. And I've seen some really interesting posts from you about how you're helping investors to pivot post-budget, because cash flow seems to be the real killer at the moment. What's your read?
Yeah, 100%. So, since budget night, we've had to really assess different approaches to investing. Look, investing's not dead. It definitely isn't dead. It's still a great wealth accumulation approach or strategy to build wealth for average Aussies. But look, for our client base, we've just had to start to think about, well, what kind of an approach, what kind of assets do we want to be adding into our portfolios, whether it be dual occupancy, little unit blocks out in the regions. We've been very active in that space for quite some time. The humble house and granny flat is definitely worthy of considering now. So the old buy and hold and hope and pray method perhaps has been thrown out the window. So it's just looking at slightly alternate approaches.
Mm. And when we think about property investing over, say, a 5 or 10 year time horizon from now, I'm keen to hear your thoughts, because there's no doubt that sentiment's in the toilet. We're seeing markets contract to some degree if you're looking at Cotality's data. I don't think anyone's talking about a boom within the next 6 months, but are you still bullish about the long-term fundamentals of property in Australia?
Yeah, 100%. Look, I think we're just chatting off air. We're still in a massive shortage of supply. We've got far too many people coming into this country when compared to the amount of dwellings that are on offer. So that dislocation in dynamic is going to underpin the market direction. I was at a bit of a conference earlier this week with and one of the guest speakers was Simon Kutchermacher from the Demographics Group, and
yep.
Some of the stuff that he's talking about just really underpins where the direction of this Aussie property market is leading, and it's very simple economics. It's the supply of dwellings is super tight and it's not going anywhere. Government aren't building or approving dwellings at the rate that they told us that they were. And then on the demand side, it's pretty high. So still pretty bullish in terms of the direction.
Well, I suppose there's overall the property market, which we can't invest in, and then there's the locations around the country. And with supply being an issue, it's of course lumpy depending on where you go. What are you sort of observing around the country in terms of areas where just the supply isn't coming on in ways that support a stabilised property market?
So, look, in some of our big capital cities, you go into some of those greenfield areas, talk Sydney, southwest and the northwest, supply isn't a huge problem, but the challenge is the supply is in an area that not many people really want to live. Take Box Hill, for instance. There is so much supply in that market. Easiest suburb that you could buy in today. It's quite frightening in terms of how much is on the market available to sell, to purchase, and then The availability of land in that area is huge, but it's just not an area that really is exciting to be moving to because it's so far from the CBD. Transport is atrocious. So, look, areas that we're still seeing tight supply are some of our regional cities. We're still very, very, very active in certain parts of Newcastle. Not much supply going out there. I think if you look at the western fringe of Newcastle, you've got places like Cameron Park, you've got places like Fletcher. Still a bit of land to come to market, but it's not being released at a rate that's altering the direction of that market. Places like Albury, Wodonga, places like central Geelong. There's not much supply going on there. A bit further south into Armstrong Creek or up north into Lara, sure, there's supply, but if you want to live in central Geelong, there's just not much there. Launceston, Hobart, we've been a pretty active buyers in those two cities. It's inexistent. There's just no supply going on at the moment.
It's interesting to also observe the stimulus now is really towards new builds, right? And we've just finished some research where we analysed 2 months worth of rental listings data and compared sort of median rents for established versus new. And you're paying around about a 5% rental premium to have a new versus a comparable established. And in apartments, it's actually 10% more in rent. And it kind of makes me think about the Treasury modelling of, these changes will only have rents go up by $2 a week. Just by changing from established to new, already we're talking, thousands of dollars a year differential. But what do you see is the future for rents, given this change has to put a dent in investor participation and transactions, would you say?
Well, look, I think if we're going to see less investment activity moving forward, well, that's going to be a drop in supply of available renting dwellings that will be rented put to the private rental market, and naturally that will lead to spikes in rent, and we're seeing rents growing at an alarming rate in some of our cities. Look, we're also the benefits of being property managers in a couple of different cities across the country, and we're seeing rents grow at a pretty rapid rate. So and look, tenants are at the wrong end of the stick in that respect. And look, I think it's not going to slow down. I can't see that slowing down, especially with less investors participating in property investing.
I'm keen to hear what some of the conversations are like that you're having with people that are getting in touch with you, the people that are sort of saying, Ben, you helped us out a couple of years ago. I know things have changed, but we want to add to the portfolio, or new inquiries where they're sort of saying, what do we do now? Like, we still believe in long-term property like you do, but we can't afford necessarily $500 a week negative cash flow. What are you having conversations like that? Like, what can you share with us?
Yeah, 100%. Yeah, so look, we've got a lot of our clients that we've worked with, say 5, 6, 8 years ago. A lot of them are coming back now. It's just more being opportunistic. As we all know, it's the best time to be buying is when fundamentals are still quite solid, and there's less buyers. And in some of our cities across the country, that dynamic is has never been truer, and we're being able to pick up assets, just with a lot less of competition. But when chatting to these, be it existing clients or new clients coming on board, the simple buy and hold approach is just not going to cut it, because that's going to result in a pretty hefty cash loss. And you don't want to be, I guess, experiencing that. But sure, you're going to be, your cash loss is going to be utilised later down the track when the property is profitable. So negative gearing isn't disappearing; it's just being pushed, to a later date. But conversations we're having is just think about different approaches, different strategies, be it buying an existing dwelling but then adding some value to it, so we can see an incremental in rent, but then also a bit of an equity uplift as well. So we're doing sort of cosmetic renovations to some of our assets. We're looking at opportunities where we can add a secondary dwelling relatively quickly to boost the income and naturally reduce the loss on that asset. We're doing a lot of small be it regional unit blocks, so blocks of 3, blocks of 4, up to blocks of 5. They can be phenomenal income generating approaches that are available to your non-sophisticated investor. I've got a couple of those in my portfolio. They've done phenomenally well. So it's just thinking a little bit more strategically around what you're going to do in terms of your acquisition. What's your approach, and how can you reduce that sort of cash flow burden?
So obviously opportunities around uplift, which would of course uplift the equity but increase the yield on the particular asset, all costs included, houses and grannies that already are running at a higher yield. But with some of these things like unit blocks, as I think I mentioned, I've seen some of the stuff that you've put online. How close are we to positively geared on these sorts of strategies, or are some of them indeed cash flow positive after all? And then I suppose a follow-up question to that is this old story that you can't have cash flow and capital growth. So are you just sacrificing the future of that particular asset just to be able to hold the thing?
Yeah, so talking about those unit blocks, look, again, your cash flow negative versus positive is really a determining factor of how much that particular investor is borrowing. But look, a lot of these assets are close to neutral or a slight negative position when they're 100% LVR. So a lot of our clients are borrowing 100% because they're leveraging equity from another asset. So you're really reducing that cash flow drain. When it comes to the yield versus capital growth, is there a trade-off? Look, you can still achieve both, provided that you buy really well. And just take the unit blocks as an example. Our approach is buying these things on one title and then having the ability to do a strata title subdivision. Just by doing that, and it's not achievable on every asset, but provided that you do your due diligence and make sure that the internals of those units have fire-rated walls or that kind of stuff that council will happily allow a strata title subdivision. You can then sell these off one by one, or you go to the bank and then they will value them as individual assets. That could be an instant equity uplift, and I think it's an approach and a strategy that I don't see done very well or very often, or it's done in quiet perhaps, but it's a great approach, and I think we've done about close to 10 of those just this year alone for clients.
That's a very interesting one, because I was going to ask you about these unit blocks. Is part of the strategy to subdivide or strata title them is a better way to put it, because I'm guessing that the pool of buyers that are available to buy a block of 4 units is a lot smaller than individual unit purchases, which would impact the price, right? Like we always, we think about the idea of getting a bulk discount. I suppose when you're buying 4 units on a block, there's a baked in bulk discount as a type. So I'm interested in, what are some of the costs involved in doing something like that, and what sort of ROI would you be talking on a project like that if you can find something that is a little bit easier for the council to get through without some major construction changes?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so look, the price point that we're kind of focusing on a lot for most of our clients is still sub 1.5 mil. And when you talk about buying blue chip unit blocks and there's massive kind of buy-in savings in terms of buying in bulk, that does exist. But you're probably looking at be it Sydney, Melbourne, sort of metro kind of assets where and there's a few buyers agents that I see do that. You might buy a $5 or an $8 million asset and then subdivide that into 10 different or 12 different individual dwellings and sell that off to your investor base, and there is a nice savings involved in that. But look, for us, a lot of ours is circa sub 1.5 We're talking it could be anywhere from 6 to 7% gross yield. Look, these are big cities. We're buying in very large regional hubs, regional centres, not in the middle of nowhere. So look, your yields are still 6.5 up to 7 as a guide. So naturally, you're getting to that sort of cash flow neutral. In some cases, if the client's borrowing only 80%, it is in a positive territory.
Yeah, that is interesting. I suppose after expenses, it depends how you slice and dice it, pre and post tax and those sorts of things. But that's 6.5, 7 now with what we sort of prefaced in the chat earlier, where we both believe that rents have only got one way to go, even if that is negative, to the tune of $300 or $400 a week. I don't think it's going to take very long before that actually starts washing its own face, right?
Yeah. And also, look, we're buying, anyone that's buying now, we're buying at elevated interest rates. This is not the normal interest rate, I don't believe. We're going to, we might see another interest rate increase, but there will be a time where we're going through a rate cutting cycle when the economy's needing some sort of a boost. It could be next year, who knows? But then those clients that have bought those assets, or those investors that have bought those assets, you're going to start to see, your costs come down, your cost of capital coming down, your rent's continuing to increase, and then naturally you'll see, a profitable position on those assets, which is exciting, and that's something that we're kind of, I guess, demonstrating to clients now. It's like, well, hey, you're buying today, your interest rates are elevated. Think about, well, what's it going to look like when interest rates are back to some sort of a normalised rate, and then make decisions based off that.
Yeah, 6 or 7% gross yield in an environment where interest rates are 2 or 3% would be far more attractive than it is today. It's a good point, right?
Yeah, absolutely.
I'll have one of those if you don't mind. So, for the next little while, I suppose there will be a window where the buying opportunities are there. I'm hearing from some people that work in the investment and the owner-occupier space that post-budget, even owner-occupiers were doing nothing, because I guess if there's a sentiment shift, if there's uncertainty, people will avoid making actual decisions. I've heard in the last week or so, which is maybe only going to be a week later than we've recorded this when we actually release it, that owner-occupiers are back. They might not be back 100%, but they understand the rules, they understand the change, they've got confidence that there will be a sunrise and a sunset. Could the same be said for investors, or do you still think we've got more of a buying window?
So 100%. I think we're starting to see, even through our own client base and new inquiries come through, we're starting to see a little bit more activity, people wanting to have that conversation. A couple of weeks post the budget, it was quiet, it was dead, and I think that was understandable as people were dealing with that shock and coming to terms with what to do next. But as time has gone by, it's like, yes, we understand where the rules sit. Perhaps they may get repealed, who knows? But let's just use or make decisions based on what they are today, and continue on the merry way. I think people are still wanting to build wealth, wanting to create a better future for themselves and their family. They're not going to stop. They're not going to stop at all, but perhaps they just need to change approach, and that's what we're definitely seeing.
When we saw the depreciation changes happen in 2017, where they basically took all the plant and equipment deductions away unless you're buying brand new, we did see in our own data of quite a reasonable increase in the proportion of people buying new versus established. I would argue that the budget change is 5 times more beneficial in terms of new compared to the after-tax position as that change. So I can only imagine that we will see an even bigger run to new property. This isn't me saying that that's a good idea or a bad idea, but I'm keen to hear your thoughts, because there will be some people that decide to go into new, and if things are repealed, they might kind of think, gosh, I wish I hadn't done that. Or if things stay the way that they are, they might jump into new and, have the old rules of a negatively geared property with the more beneficial CGT. Where do you land on that sort of debate?
Yeah, so look, we're still focusing on established properties only, but it's not to say that we're anti-new properties. I think there's kind of two different approaches that you can take when thinking of new dwellings. You've got one avenue, which is buying into a heavily supplied greenfield development area, going out and buying a house and land package. Is that going to do well? Highly unlikely. But if you're looking at a new style of asset in an area that's more of an infill development area, within an established area, a suburb, etc., look, that's not a bad approach. We're still seeing our client base wanting to focus on established, so they have the ability to add value and create additional dwellings, etc. But others that we have come across as well that want to focus on new, I'd be saying if that's your jam, then try to approach it from an infill development area in an established suburb as opposed to out in the greenfield areas like your Box Hills or your southwests of Sydney, where you've got just land there to be chopped up as far as you can see. Melbourne's probably even worse as an example, where there's just so much land available, where Melbourne just continues to build out. That's probably more of a risk there.
Yeah, I suppose in some respects, when I talk about new, the image that comes to my mind is an off-the-plan apartment in a complex of 200. I don't think there's ever been a great time to buy one of those. No. And then if we talk about units, when I talk about, a good investment as a unit, it's probably one of those bomb-proof walk-up ones with very limited facilities and, maybe 50 years of opportunity to see building defects that probably aren't there because they ain't building them like they used to. And if we talk about houses, I suppose the nightmare scenario is exactly what you're talking about. It's a paddock that's been rezoned, surrounded by other paddocks. So there's really not much of a limit to the supply other than the construction economics of what's going to stack. But these infill opportunities, I'm wondering, like, the tax differential is so big now that if you can find an infill new property, but you're not paying a huge premium because there are other investors chasing those tax returns. I mean, I've always said that, tax is a bonus, not a strategy. Is that maybe an area that you think people will be putting more attention to and less likely to face those risks that are around scarcity and supply?
Yeah, it could. Yeah, it could happen. But like you said, it's very hard to find those opportunities. New in an established kind of an area. Through an infill kind of an approach. Very few and far between. But let's touch on your point about units. Yeah, we've been buying units for years, and it's those the old school single level, more like villas in a block of 2 or a block of 3, block of 5. In a real solid location, be it a Geelong or up in Newcastle. A great approach for clients with smaller budgets. Yep. Let's just say, circa 600,000. You want to buy a little 2-bed, 3-bed villa in a cracking suburb of Geelong, as opposed to a freestanding house on a piece of land out in the middle of nowhere. It's those kind of conversations that we're having with clients, and there's nothing wrong with units. And in some cases, we've seen unit growth, far surpass the growth of houses because of affordability and desirability too.
Yeah, and that's a good point. And I think it's something that Terry Ryder was talking about a couple of years ago. I hear some anecdotes about some rolled eyes from buyers agents with this idea that units will never outperform houses. But affordability's got to be part of it. And I wanted to ask you, because there are some buyers agents that will say, look, if you haven't got 800K, you're not going to work with us because we don't see any value in anything under 800K. Sure, it might go up in value, but the risks in terms of the local demographics and CIFA scores and all of those sorts of things just mean that they don't necessarily want to touch it. However, if we think about price movements, I think in the 6 months to March, Cotality showed that below the 5% deposit caps, we're talking about 6.8% growth, whereas I think above the caps it was about 3.8. Those numbers are out by maybe a couple of decimal points there. But the lower end of the market was delivering those gains, and I feel like investors will always be more prevalent at the lower points, and first home buyers will be looking to get obviously something that fits their purpose, but as cheap as possible. So I'm wondering, do you think some people maybe have it wrong to say we're not transacting unless we're at that point? Do you believe that there are potentially there's more heat in that bottom end and better opportunities?
100%. You've hit the nail on the head. In certain cities, sub 600,000 is ridiculously hot. And if we look at where we're sitting today, right, where certain parts of, say, Sydney, Melbourne, prices over 2 million, that marketplace has been decimated. We're seeing some pretty frightening figures. But if you look at the complete opposite spectrum, sub 600, sub 800 to a degree, it hasn't changed. It has not changed at all. Competition, buyers at open homes, like certain parts of Geelong where we've got buyers agents down there, looking for assets circa, sub 650, and we're talking, little villas or townhouses. It's a tough place to buy. It's a very tough and challenging place to buy because you've got a mix of host-owned buyers. You've still got investors. It's rapidly growing. We look back at assets that we bought, say, late 2025, early 2026, and we've seen growth already, which is exciting.
Is there any credence to these ideas that if you're buying, let's just say sub 600, then you are going to suffer with maintenance issues, or you're going to suffer with, crime or issues with arrears or anything like that? What's your read?
So again, we'll put my property manager hat on. We manage some properties in, sort of lower socioeconomic areas, be it up in Newcastle, be it down in Albury. You have issues everywhere, but we find them to be some of the better tenant profiles. Right. So I think it's so many variables at play. We manage some real high-end stuff here in Sydney. Sometimes those tenants can be a complete nightmare. So it's a real mixed bag. It's just having your due diligence in place and making sure that you know how to, I guess, really assess a tenant profile, etc.
Yeah, it's a good point. I think I've inspected thousands and thousands of properties over the years, and probably the worst one that I ever saw was rented for way above the median price by two surgeons who were never home and lived like absolute animals. And, they were on big biscuits, I'm pretty sure. But this idea that, if you're at the lower end of socioeconomics, that you're a bad person or a criminal person, I think is maybe something we need to move on from, right?
Yeah, no, you're spot on.
All right, so we're in July 2026. The world has changed for property investing since the 12th of May, but the long-term fundamentals for property, you're bullish on, I'm bullish on, and I think most commentators in the space, whether they've got an invested interest or not, agree, just because of the fact that we're not building them fast enough. There's too many impediments, and immigration is still off to the races. What do you think is the best thing that you want to leave with listeners today who have absorbed the changes and still want to build their financial future and be decisive and make an investment decision in the back end of 26?
Look, I think it's important to continue on your plan, to continue on your journey. I probably made the most money in property at the worst possible times of economics, right? You look at COVID, back to the GFC, like, buying in a time where there is less competition, that's when you want to be buying. Because I guarantee it, give it another, let's say 12 months when the market perhaps is a very different situation to now, you'll see people come out of the woodwork and say, yeah, I'm ready to buy. I say, well, it's bloody hard now. So I think for investors, it's really important to be very conscious of cash flow, review your existing portfolio and really have a good sense as to what's the logical next step for your own portfolio, but just continue on your journey. I know I am. I bought a couple of months ago, and will continue to do so. So don't give up.
I love that, mate. I think that's sage advice from you as always. Thanks very much for sharing those insights and giving us a bit of a glass half full look at the next little while. I appreciate it very much.
Thanks, Mike. Thanks for having me.